You ever see a low mortgage rate headline and think, finally, time to buy? And here's the shock. The typical mortgage payment might be easier, but in our world, the real cost of owning a home, taxes, insurance, maintenance, bills, just hit an all-time high. According to a recent survey, many homeowners now pay as much as $24,500 a year in non-mortgage housing costs. That means owning can feel like a dream until the bill shows up. Today, I'm going to show you why the market window you keep hearing about could be a trap, and what you need to know before you jump in. If you think you're getting ahead by locking in a rate, think again. I'm talking about the hidden expenses draining your equity, your budget, and maybe your future. Over the past few months, mortgage rates have slid downward. The average 30-year fixed mortgage rate is now about 6.375%, slightly lower than earlier this year. Thus, that drop has flicked the buy sign on for many Americans who've been renting or waiting for the right moment. At the same time, the cost of everything else tied to homeownership, insurance premiums, property taxes, utilities, maintenance, has surged. The same survey found that Arsenal non-mortgage homeownership costs averaged nearly $25,000 per year, up sharply from prior years. So while low mortgage rates might lower your monthly payment, the total bill could still kill the deal. Think about it. When you sign for a mortgage, you're only seeing one line on a contract, the payment, but that number is only part of the real cost. Imagine you lock in that 6.375% 30-year loan. Your mortgage seems manageable, but now add insurance that might be 70% higher than 5 years ago, property taxes that keep climbing, rising utility bills, and inevitable maintenance. The affordable home begins to look expensive. And here's a hidden danger for many homeowners. Valuations. As home price growth continues in many regions, though unevenly, property taxes tend to follow. For long-time owners, that can mean a creeping rise in annual taxes, even if the mortgage rate is fixed. And if you're a new buyer, your projected costs might be dramatically underestimated. Low, systemic societal impact. This dynamic has broader consequences. For one, many first-time buyers. The people mortgage rate headlines claim are winning are being excluded. According to a War report, first-time buyers now make up only about 1 in 5 home sales. That's the lowest share since tracking began, meaning affordability headlines don't translate into real home ownership opportunities for lots of folks. Meanwhile, homeowners with large equity pockets, often older, wealthier households, are the ones best positioned to absorb unpredictable expenses. That accentuates inequality, and it affects mobility. People who thought they'd finally buy may stay renting. Others who bought might later sell, or even default when hidden costs spike. In fact, foreclosures have been rising lately as many Americans struggle with soaring non-mortgage homeownership expenses. Consider Kelly, a teacher in a mid-sized Midwestern city. She took advantage of falling mortgage rates this fall and bought a modest 3-bedroom home. On paper, her payment was manageable, but within 6 months, higher property taxes, an insurance premium shock, and steadily rising heating bills turned that dream into a financial burden. She's now reevaluating if it's worth staying put. Then there's Ramon and Clara, empty nesters in Florida. They locked in a favorable mortgage this year, hoping to enjoy retirement without rent. But property taxes and homeowners insurance shot up, cutting deep into their fixed income. Many seniors across the country face a similar silent squeeze. And for young couples, first-time buyers, many are getting priced out entirely. With tight inventory and rising total costs, they're watching affordable homeownership slip further away, even as rates drop. So what can you do if you're buying or already own or thinking about buying? First, run the full numbers, not just the mortgage. Include taxes, insurance, maintenance, utilities, and even likely increases over time. Second, think in terms of total housing cost. if your total cost goes beyond what you're comfortable with, even if the mortgage seems cheap, wait or adjust. Third, build a buffer. Experts often say to have at least 3 to 6 months of expenses in reserve. With today's volatility, that buffer might need to be bigger. Fourth, treat homeownership like a business, not just a dream. Question assumptions. Expect hidden costs. Reevaluate periodically. So here's the question to leave you with, and I want you to think about it before you hit like or subscribe. If a low mortgage rate hides a ticking bomb of taxes, insurance, and surprise bills, is homeownership still a path to financial security? Or is it just another risk disguised as a dream? Leave a comment below. I want to know, if you owned a home right now, what surprised you the most when the bills came? Because this isn't just about rates or prices. It's about being honest with what owning a home really costs in America today.